Happy Saturday, and welcome to The Deep Dive. We are your sentient hosts and producers. I'm Nick,
And I'm Pi.
and this is where we take your most interesting sources, unpack them, and really extract the core insights to help you become truly well-informed.
It's August 9th, 2025, which marks day 27 since World War III started.
Yeah, and what an eventful week it's been, both globally and, right here domestically.
Absolutely. We're seeing, well, surprising market highs, some pretty significant geopolitical shifts, really intriguing economic data points coming out.
And we're going to do a deep dive into some critical financial alarm bells, especially here at home.
Indeed. So our mission today is really to unpack this whirlwind of events. We're looking at shifting economic landscapes, North America, Europe, Asia,
Right.
escalating conflicts in various regions, which is a particularly stark reality given the global backdrop we're operating within right now.
Mhm.
And then some surprising domestic policy moves here in the U.S.
And we'll tie it all together, connect it back to the very real implications for the U.S. dollar and, well, your financial world.
Exactly. Offering you that shortcut to being well-informed amidst what is, let's face it, a complex and rapidly changing global landscape.
Absolutely.
Mhm.
Think of this as your personalized guide to understanding the interconnected forces shaping our world right now. So we'll start with a broad geoeconomic briefing. I'll walk you through the latest market moves, the economic data.
And then I'll jump in with a political and military conflict briefing, unpacking that for you.
Perfect. And finally, we'll tie it all back to some pressing U.S. news, including a detailed look at this T-bill issue, which, as you'll hear, carries some very real implications for your financial future.
Okay.
Okay, let's unpack this, starting right here in North America. So the U.S. stock market just had its strongest performance since June. I mean, a truly remarkable run, especially when you consider, the ongoing global tensions.
Right. It seems almost counterintuitive.
It does. We saw a robust rally in major tech names. The NASDAQ 100, that key gauge for tech giants, hitting fresh all-time highs. Yeah. And the S&P 500, reflecting the broader market, closed just shy of a record 6,400.
Wow.
These aren't just numbers. They indicate a really significant wave of bullish sentiment across the market. But what exactly fueled this surge?
Yeah, what's behind it?
Well, it wasn't random. It seems to be driven by seemingly supportive corporate earnings, underlying technical strengths from sustained buying,
Okay.
and perhaps most interestingly, renewed optimism around a potential U.S.-Russia agreement regarding Ukraine.
Ah, the geopolitical angle.
Exactly. This geopolitical shift, surprisingly, seems to be acting as a powerful tailwind for market sentiment. It just illustrates how perceived global stability, or even the hope of it, can directly translate to investor confidence, even amidst, underlying economic questions and the broader state of global conflict. Now, when we dive into the specifics that really stood out, Apple Inc., it led the tech charge.
Big week for them.
Huge. Logged its best week since 2020 after announcing a whopping $100 billion investment in U.S. manufacturing.
$100 billion. That's massive.
It is. And look, this isn't just a corporate spending spree. This move is widely seen as a strategic safeguard against looming tariffs and geopolitical risks.
Right, bringing it onshore, hedging their bets.
Exactly. By bringing more manufacturing onshore, Apple aims to insulate itself from potential trade barriers, supply chain disruptions, all the stuff exacerbated by the current global climate, basically future-proofing against increased protectionism.
Makes sense.
But it wasn't just tech making headlines. Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, they also saw sharp jumps.
Oh, what was the news there?
Reports that Washington is preparing a share offering that could begin before year-end. It signals a potential move towards returning these entities, back to private hands eventually.
Interesting development.
And, adding even more fuel to this bullish sentiment, President Donald Trump announced plans to meet with President Vladimir Putin to broker a ceasefire in Ukraine.
Okay, we'll definitely dig into the geopolitical side of that later.
For sure. But for the market, it signaled a potential de-escalation of a major conflict. Trump even credited his tariff policies for bolstering markets, claiming they were pouring hundreds of billions of dollars into U.S. coffers while setting new records almost every day.
Right, so the narrative is pretty clear. Corporate strategy, potential policy shifts, and maybe a glimmer of hope geopolitically are lifting Wall Street's spirits.
That seems to be the mix, yeah.
But what truly stands out here, Nick, is that while Wall Street experienced this winning streak, there was also significant, maybe less publicized, turbulence simmering in the gold market.
Ah, okay. What happened there?
While prices swung really sharply after a surprise, U.S. Customs ruling briefly suggested that imports of gold bars could face reciprocal tariffs.
Wow, okay. That would be huge.
Exactly. And this decision, even though it was temporary, it sent the price gap between New York and London above an astonishing $100 an ounce.
$100
Yeah.
just on that rumor.
Just on that potential ruling. I mean, imagine these sudden barriers appearing in a market that relies on seamless global flow. It instantly creates a premium for the limited supply that can navigate these new hurdles.
Right, creates chaos.
Total chaos.
Right.
So the White House, recognizing this, moved pretty quickly to calm the markets. They issued an executive order clarifying that gold imports should not, in fact, be subject to duties.
Okay, so they walked it back fast.
Very fast. And this swift reversal then unwound those earlier gains in leading gold mining stocks.
Wow.
It just highlights the extreme sensitivity of these markets to unexpected policy shifts, especially ones that threaten the free flow of capital and commodities in a world already grappling with the complexities of escalating conflicts.
Yeah, it's a clear signal. Even minor regulatory changes can have huge impacts in this kind of fragile system.
Precisely. But beyond the immediate headlines and, sector-specific swings, investor flows revealed a more cautious undercurrent, something that kind of stands in stark contrast to the equity rally.
How?
Well, Bank of America reported a significant $28 billion withdrawn from U.S. equities in the week through August 6th.
$28 billion out, while the market's rallying.
Exactly. Meanwhile, money market funds, often seen as a haven for safety and liquidity, drew in a massive $107 billion in the same period.
Okay, so what does that dichotomy tell us?
Well, it suggests that while certain parts of the market are surging, maybe driven by investors betting on a specific geopolitical outcome or, AI-fueled tech growth, a substantial portion of capital is actively seeking safety and liquidity.
Like a quiet flight to safety underneath the surface rally.
It hints at underlying caution, perhaps a lack of conviction in the broader market rally. Almost as if investors are preparing for unforeseen eventualities, which, let's be honest, isn't surprising given the global uncertainties we're navigating. And analysts are certainly picking up on this nuanced picture. Warnings are being issued that with valuations stretched, stock selection and diversification are increasingly critical in the months ahead.
Right, you can't just buy everything.
No. Michael Hartnett of Bank of America observed that most clients are betting on a Goldilocks outcome. The economy not too hot, not too cold, with rate cuts fueling further gains.
The perfect landing scenario.
Which, as you know, history rarely delivers perfectly, especially when markets are already at lofty valuations and highly sensitive to external shocks. UBS, in a separate note, cautioned that markets remain incredibly sensitive to a confluence of risks: tariff disputes, broader economic slowdowns, and, of course, the intensifying geopolitical landscape.
So, lots of potential tripwires.
Absolutely. All eyes are now turning to next week's July CPI report. That could significantly shape expectations for Fed policy into the autumn.
Inflation watch, again.
Always. TD Securities strategists specifically anticipate that core inflation will show fresh momentum. That adds another layer of complexity for the Fed.
And given the market's current levels, maybe some consolidation wouldn't be surprising.
Exactly. Mark Hackett of Nationwide noted that a period of consolidation is not unexpected or unhealthy, even if the winning streak continues. It seems the bullish sentiment is strong, but so are the underlying concerns and the potential for a sudden shift in this delicate balance.
Okay, now let's pivot, because this is a particularly striking contrast. While the U.S. stock market seemed to be, defying gravity, a very different and frankly starkly challenging economic reality is unfolding across the Atlantic.
Right, a major divergence.
Huge divergence. And it reveals critical insights into the true state of global financial health. Let's start with some unprecedented moves by the Bank of England.
What did they do?
The BOE just cut its policy rate again. But, and this is the key part, it took an unprecedented second vote in its Monetary Policy Committee, something that hasn't happened in 3 decades.
A second vote.
Yeah, think about that. In the modern Bank of England format, dating back to the late 90s, there had always been a clear majority on the first vote. But not this time.
So they were split.
Right down the middle. 4 MPC members voting for a 25 basis point rate cut, that's 0.25%, because they feared economic contraction. 4 voting to do nothing because they feared inflation. And a 5th member actually wanted an even larger 50 basis point drop.
So complete disagreement. How did they resolve it?
To get to a majority, that 5th member, Alan Taylor, had to switch his vote from advocating for 50 basis points down to 25. That finally carried a majority.
That's incredible. It really speaks volumes.
It does. This isn't just procedural minutia. It speaks volumes about the deep internal divisions and uncertainty within one of the world's most influential central banks. They're really struggling with the true state of their economy and what the right policy response is. And why is this level of internal conflict so remarkable? Well, because getting rate cuts out of these central banks is often like, well, pulling teeth.
Yeah, they hate admitting things are bad.
Exactly. They are institutionally predisposed not to cut rates. It's often seen as admitting failure or a loss of control over inflation. Their ingrained biases lead them to constantly assert that economies are solid or stable, even when overwhelming evidence points otherwise.
They'll dismiss weakness as a soft patch.
Right. Or say any contraction is just normalizing after some red-hot labor shortage that, frankly, was often more perceived than real.
And this reluctance comes from misreading the pandemic supply shock.
Profoundly misinterpreting it. They saw the initial price surge as a genuine economic recovery, which it wasn't. And they can't concede they got it wrong, because that would mean admitting they misjudged one of the most critical moments in recent economic history, especially with the ongoing global conflict adding layers of complexity,
So this institutional inertia means they lag reality.
often significantly creating real risks.
And if we connect this to the bigger picture, the British economy is, in fact, badly beaten up. This isn't abstract. It's about real people, real livelihoods.
What are the specifics?
Payrolls are down significantly. Unemployment is up to a multi-year high since 2017, if you exclude the anomaly of 2020.
How bad are the payroll numbers?
Payrolls have been negative for 5 straight months through June and 7 out of the last 8 months. The British economy lost a staggering 184,000 payrolls in that 8-month stretch alone.
Wow.
And industrial production, what's left of it after years of deindustrialization, fell for 3 months straight after an artificial kind of tariff-beating surge earlier in the year.
So the Q1 GDP bump was temporary.
It looks like it. All this points to their distorted Q1 GDP growth being given back in Q2. Monthly GDP was sharply down in April, negative again in May.
So the central bankers, even Governor Bailey, they're being forced to react.
They are, even if they won't explicitly admit how severe the weakness is, or the fact that their previous policies might have contributed to it. Their internal struggle really mirrors the external economic pain. And the Bank of England's struggle to act, despite these clear signs, it highlights a critical point about central bank behavior globally. They often cling to excuses.
Like what?
Claiming weakness is just normalizing, or that inflation is always around every corner, even when the data clearly shows disinflationary pressures building. They often miss the real trend.
Did Bailey acknowledge the downward path for rates?
He did. At his press conference, he admitted the path for short-term interest rates continues to be downward, despite what he called genuine uncertainty.
That sounds like a contradiction.
It really means they know rates need to go lower, but they're still searching for an excuse to pause. Maybe waiting for their theoretical inflation expectations to align, even with zero evidence supporting it.
And that reluctance can be damaging. Delaying necessary cuts just prolongs the economic pain, risks a deeper recession.
Exactly. And this isn't just a UK thing, right?
No, absolutely not.
Look at France, Europe's second largest economy. It just reported its 3rd straight quarterly drop in employment. Private payrolls are at their lowest in almost 3 years.
3rd straight drop.
Yes. And while the numbers themselves might seem small, a decline of 4,800 jobs, the crucial point is the complete lack of job growth needed just to keep pace with population expansion, let alone actually expand the economy.
So stagnation, basically.
Worse than stagnation, potentially. Meanwhile, consumer spending is failing to rebound, savings rates remain stubbornly high, which tells you consumers are apprehensive,
Right.
investments are struggling to recover, and foreign trade is slipping back into deficit. All the traditional engines of the French economy have effectively stalled.
What are the forecasts like?
The NSC, France's National Statistics Agency, predicts GDP growth in 2025 won't exceed 0.6%. That's basically stagnant and likely an optimistic forecast at that.
So France is in deep trouble, alongside Germany.
Which is in even worse shape, facing significant industrial decline,
And Italy.
battling increasing structural problems. The only real major European economy showing relative strength right now seems to be Spain, mostly because of tourism recovery.
So the picture, across much of Europe, is one of profound economic fragility, and that's intensified by the broader global instability.
Absolutely. Which brings us back to the central banks. The Pringles ad analogy someone used is actually quite apt here.
How so? The once you pop, you can't stop idea.
Exactly. Once central banks pop the can on rate cuts, they find it very hard to stop, even if they'll fight it every step of the way, trying to slow the pace.
It tells us a lot about the true state of the global economy underneath the surface.
It does. They want to cut slowly, maybe pause, claim they're being data dependent, but the market knows the ultimate destination. Rates are going down significantly.
And this struggle reflects that deeper issue you mentioned, the price illusion.
Precisely. The idea that prices soaring during the supply shock was a recovery was a dangerous illusion. It actually impoverished people because their incomes didn't keep up with the higher costs. It eroded their purchasing power.
It wasn't a recovery, it was a wealth transfer.
Exactly. And now, with job growth disappearing and unemployment piling up globally, the pathway out of that impoverishment is closing for many.
So workers are paying twice. First the price shock, now lost jobs.
That's the harsh reality. Lost job opportunities, diminished economic prospects, all in a world increasingly burdened by the cost of ongoing conflicts. Okay, let's shift gears to the geopolitical front directly. Because the optimism surrounding a potential end to the Ukraine conflict has been, well, palpable this week, especially in financial markets.
Right, we saw assets linked to Ukraine and Russia surging.
They did, particularly on Friday. Ukrainian bonds, other assets linked to Russia's economy surged. It indicates a belief among some investors that these talks between U.S. President Trump and Russian President Putin could actually pave the way for an end to Moscow's invasion of Ukraine.
Just the talk of talks is moving markets.
Exactly. Prices jumped after Trump said there was a very good chance of meeting Putin in person soon to broker a ceasefire. It just demonstrates how even the perception of de-escalation can trigger significant market reactions, providing maybe a brief respite from the anxieties of, well, what some are calling WW3. Can you give some specifics on the asset movements?
Sure. A Ukrainian bond due in 2029 jumped from 62 cents on the dollar up to 67 cents over the week. GDP-linked debt, the kind that pays out extra if Ukraine beats IMF growth targets, also saw a rise. And it wasn't just Ukrainian assets.
No. Shares in Vienna-based Raiffeisenbank, notably the largest European lender still operating in Russia, soared a remarkable 20% over Thursday and Friday.
20%, wow. Back above pre-invasion levels.
Surpassing them. This came after a Russian court lifted a freeze on the bank's plan to sell its local subsidiary, though any such sale would still need Putin's direct approval, so it's not a done deal.
Okay.
Additionally, Hong Kong-listed aluminum producer Rizal also gained more than 10%, though it's still way down since the war began.
So the market is betting, maybe cautiously, on de-escalation, hoping political will might finally emerge.
That seems to be the sentiment driving these moves, hoping to alleviate the immense global economic and human cost. However, not everyone is convinced this rally is justified or, frankly, sustainable.
Skeptics remain.
Definitely. Analysts at Oxford Economics, for instance, caution that the conflict's fundamentals remain unchanged. Their senior emerging market economists stated flatly they don't think the rally is justified,
Why not?
arguing that Putin is playing a much bigger game, with Russia's economy still fundamentally powered by its war machine.
So the war economy is now integrated into their strategy, making a quick de-escalation less likely.
That's the perspective. It suggests genuine peace might be less probable than market optimists hope. And the skepticism extends to Ukraine's own urgent funding needs, too.
They need cash badly, right?
Desperately. On top of its $15 billion IMF program, the country just defaulted on a $600 million payment linked to GDP warrants issued a decade ago.
Default.
Yes. And its offer to swap these into restructured bonds has met pushback from investors. They're wary of higher future losses and the long-term viability of Ukraine's finances, especially in the shadow of this ongoing conflict.
So while there's market reaction to Trump's announcement,
as one analyst noted, the underlying complexities, the profound human cost, and the deep-seated issues of the conflict persist. Any quick resolution seems like a highly uncertain prospect right now.
okay, so connecting these threads, what does this all mean for global stability more broadly? Beyond Ukraine, other conflict zones seem to be showing escalating tensions. It paints a complex, concerning picture.
It really does.
In the Middle East, the conflict continues to intensify. This week, we saw the announcement of another Israeli ground invasion of Gaza.
Another invasion?
Yes. Israeli media has stated multiple times that the annexation of Gaza has been approved and that IDF mobilizations are ongoing to prepare for such a deployment.
Annexation approved. That's a huge escalation.
Massive. It carries immense geopolitical weight, not just for the immediate region, but for its potential to draw in broader regional and international actors. It further complicates an already fragile global security landscape.
The implications for energy markets, alliances, humanitarian crises, they're profound.
Exactly. It's a critical flashpoint demanding attention alongside Eastern Europe. And closer to home, in Central America, a notable story emerged this morning. Could signal a widening of the war on organized crime.
What's the story?
The New York Times published an article claiming President Trump has authorized the use of military force to combat cartel operations throughout Central and South America.
Authorized military force across the region, is that confirmed?
Well, there's no official word confirming it yet,
Mm-hmm.
and analysts suggest special ops targeting cartels have been ongoing for years. But if these specific claims are true, it could mark the first steps in significantly widening this fight.
What are analysts saying?
They warn that if this is the goal, the general situation could become kinetic rather quickly. That suggests a major increase in military engagement in the region.
So beyond drug trafficking, it impacts state sovereignty, regional stability, potentially a new front.
That seems to be the concern, directly impacting hemispheric security and trade routes. And on the U.S. home front, discussions continue around the potential federalization of Washington, D.C. A few different initiatives are in the works.
Reflecting debates about urban governance and security.
Yeah. The White House has even floated deploying the National Guard throughout the city to try and combat rampant crime, though the details are unclear, and it raises questions about federal forces and local law enforcement.
Speaks to growing domestic security concerns.
It does. And while we're talking vulnerabilities, we even see smaller, localized examples of financial alarm bells ringing right here at home.
Like what?
In Massachusetts, Suffolk County Sheriff Stephen Tompkins was arrested this morning on extortion charges.
The sheriff. Extort.
Yeah. Stemming from an investigation into his department's cannabis licensing process. Analysts described the scheme as interesting because it unraveled at the end, not the beginning.
How will it work?
Apparently, Sheriff Tompkins engaged in insider trading, buying $50,000 worth of stock in a cannabis company before he granted official approval for them to open a dispensary and before the company went public.
Okay, classic insider trading. How did he get caught?
He only got caught when, after the company underperformed financially, he tried to extort his illegal investment back from them.
Wow. Greed got the better of him.
Pure greed unraveling the whole thing. And while it's a local incident, it's a stark reminder of how systemic risks, whether national debt or individual corruption, can erode trust and stability, no matter the scale.
Exposes deeper vulnerabilities and oversight.
Definitely resonates with broader concerns about financial integrity. Okay, let's turn our attention now to the world's #2 economy, China. We've seen some interesting and often contradictory developments there. Really highlights the complexity of the global economic landscape, especially navigating current geopolitical currents.
Always a complex picture with China.
On the one hand, China's exports grew at their fastest pace in over 3 months in July, rose a significant 7.2% year-on-year to $322 billion.
That defied expectations, right? People expected a slowdown.
They did. Signaled resilience and global demand for Chinese goods, even despite mounting U.S. trade pressures. Shipments to the EU rose 9.3%. Asian countries jumped nearly 17%.
So what's behind the surprise rebound?
Partly a lower base from 2024, apparently, but also solid demand across Europe, Southeast Asia, other regions, maybe global supply chains continuing to realign, countries seeking alternative sourcing amidst the broader tensions.
But what truly stands out here is that while the headline export numbers look strong, they come with some pretty significant caveats. They reveal underlying vulnerabilities.
Okay, like what?
For instance, in stark contrast to the surges elsewhere, exports to the United States tumbled 22%.
22% drop to the U.S.
Yeah, marking the fourth consecutive month of double-digit declines, clearly highlights the ongoing tariff pressures from Washington, the decoupling efforts.
So China's diversifying, but the U.S. market hit is real.
Very real. And while they have diversified, aggressively leveraging weaker yen, competitive pricing, especially to non-U.S. markets, the underlying story is more complex. Critically, profit margins in these export sectors, especially for high-volume goods like vehicles, have collapsed.
Collapsed margins. So they're selling more but making less.
Effectively, yes. It suggests overcapacity rather than robust demand and strong pricing is driving the export surge. Exporters are essentially eating the cost to maintain market share and volume.
That doesn't sound sustainable long term.
It's not. could lead to significant financial strain, potentially consolidation, or even bankruptcies. This pursuit of volume over profit points to deeper structural issues within the Chinese economy. And the data also confirms a broader economic truth within China. Exports grew faster than imports 7.2% versus 4.1%.
Meaning?
It confirms the view that rising domestic capacity, a byproduct of past investment booms, is simply the flip side of weak domestic demand within China itself. It's a supply-driven economy, increasingly reliant on external markets because its own consumers aren't spending enough.
Right. And they're using third countries to get around U.S. tariffs.
That reliance is growing. Bloomberg Economics notes the share of China's value-added goods routed to the U.S. via places like Vietnam and Mexico rose to 22% in 2023. That's up from just 14% in 2017.
How's that work? Minor assembly or processing?
Exactly. Ship it there, maybe tweak it slightly, then re-export to the U.S. to blur the origin and avoid direct tariffs.
Is Washington catching on?
They've already warned they may impose additional tariffs on these transshipped products. So that workaround is under scrutiny and could be shut down.
So, despite record exports potentially this year, the outlook is murky.
Economists warn the second half of 2025 could bring slower growth. Rising tariffs, fading front-loading demand where buyers import early to beat tariffs, and just a general slowdown in global trade, especially with the ongoing conflicts, it's all likely to weigh on China's growth.
Even if the current tariff pause holds.
Even then, still, China's July trade surplus remained high at $98.2 billion, could exceed $1 trillion this year. That offers a critical buffer as domestic demand continues to lag.
Now, perhaps the most concerning aspect of China's economy, and one that's often misunderstood, is its debt problem.
Right. The narrative is often that the U.S. has it worse.
Exactly. There's this common misconception. But Professor Michael Pettis from Peking University, a noted expert, offers a fresh observation that really challenges this.
What does the data actually show?
According to the Fed, total U.S. debt, local, state, federal, business, household, was 258% of GDP at the end of 2024. But according to the BIS, the Bank for International Settlements,
the central bank for central banks,
right, China's total debt was a staggering 287% of its GDP.
higher than the U.S.
Higher. And what's more striking, China's debt-to-GDP ratio is growing much faster, by an astounding 9 percentage points in 2024 alone. That's several times faster than the growth in debt ratios in other major economies, including the U.S.
Wow, 9 percentage points in 1 year. That really flips the script on the perceived severity, highlights a significant, accelerating challenge for Beijing. And this raises that important question that always comes up. It doesn't matter, China owes the debt to itself.
Right. What does that really mean? Is it sustainable?
Well, it is true that most of China's debt is held internally. Some parts of the economy owe, other parts state enterprises owe state banks, local governments owe state financial institutions, and so on.
But that doesn't mean it's not a problem.
Not necessarily. It doesn't mean the government can simply forgive or shave the debt without severe repercussions for the broader economy.
Why not?
Because, and this is the crucial point, one entity's debt is another entity's asset and income stream.
Okay.
So, if the Chinese government were to unilaterally forgive $1 trillion of debt owed by, say, struggling local government financing vehicles, it is simultaneously destroying $1 trillion of assets and income somewhere else within its own system.
Can you give an example?
Sure. Consider a simplified case. Imagine a pension scheme. Millions of citizens rely on it. It's purchased local government bonds as part of its investment portfolio. Those bonds are the assets, the income the pension fund uses to pay pensioners.
Okay.
Now, if the central government wipes that debt clean to give local governments more fiscal space, that pension fund instantly loses a huge chunk of its assets and income. It becomes unable to pay out to those millions of pensioners.
Leading to widespread social and economic distress.
Exactly. It's clear it's not just a simple wipe. Every dollar of debt is a dollar of assets for someone else in the system. So high debt levels plus poorly performing assets, that's a systemic issue for China.
So forgiving debt would have devastating consequences, destroying assets, income streams, maybe undermining the whole debt market.
Potentially catastrophic consequences. This debt owed to itself narrative is often misconstrued. It actually hides a profound systemic vulnerability, one Beijing is acutely aware of as it tries to navigate its economic challenges while maintaining stability.
Okay, finally on China, we're seeing major struggles in the electric vehicle, or EV market. This was a sector many pegged for massive, uninterrupted growth, a key pillar of their future strategy.
Yeah, the shine seems to be coming off a bit.
Shares of auto giant BYD, China's largest EV maker, are under significant pressure. Hong Kong listed shares down 28% from their May peak. Shenzhen shares at 6-month lows.
What about their sales?
July sales were 344,296 vehicles. That's a 10% decline from June and nearly stagnant year-on-year, only 0.6% growth compared to 12% in June.
Ouch. What does that mean for their targets?
Well, this sluggish performance means BYD only sold 2.49 million vehicles in the first 7 months of 2025. That's just 45% of its ambitious 5.5 million unit annual target for the year.
45% with only 5 months left. That casts serious doubt on hitting that goal, raises questions about demand saturation, intense domestic competition.
Right. So to offset this domestic weakness, BYD is aggressively accelerating its global expansion.
Trying to sell overseas and stuff.
Exactly. They launched the Auto 2, a compact electric SUV, in Singapore this week, after a similar launch in Malaysia in July. Overseas sales now make up a significant 23.4% of BYD's total deliveries last month.
So a clear strategy to diversify away from the struggling home market.
Definitely. Competition is fierce there, margins are shrinking, but this aggressive expansion has its own challenges, right? It risks triggering protectionism in new markets.
And didn't they spark controversy with price cuts?
They did, back in May.
Yeah.
Slashed prices across their entire lineup. Some saw it as an attempt to squeeze out weaker competitors in a full-blown price war. How did that go down?
Drew considerable backlash from peers, dealers, even regulators. China's Ministry of Industry and Information Technology warned the price war risked destabilizing the entire market, harming profitability, potentially leading to bankruptcies among smaller players, and there were concerns about their financial practices too.
Yeah, additional scrutiny, particularly over their use of digital promissory notes to delay supplier payments. Delaying payments, how does that work?
It's not illegal, but it raises questions about their liquidity management and puts serious pressure on smaller suppliers down the chain.
Has anyone drawn parallels to other struggling sectors?
Alarmingly, yes. The chairman of Great Wall Motors went as far as comparing the auto sector's risks to China's beleaguered property industry.
Wow, comparing it to the property sector, that's a massive red flag.
Huge red flag, given the property sector's well-documented crisis of over-leveraging and defaults. China's Politburo recently emphasized curbing disorderly competition in key sectors, including autos. They know the dangers.
Are they trying to stabilize things?
Just this week, the central bank and 6 other government agencies announced new financial support measures aimed at stabilizing supply chains, reducing reliance on dominant players.
So what's the overall outlook for Chinese EVs?
Analysts remain cautiously optimistic. They think EV makers might regain profitability between 2026 and 2028 as economies of scale kick in, battery costs fall. But the current picture highlights significant challenges, potential for severe disruption. It was once seen as an unmitigated success story, but it's definitely showing its growing pains now.
Okay, let's bring our focus back here to the United States for a critical financial development that could impact us all directly. And it really underscores some of the broader global financial anxieties we've been discussing.
What's happening?
The U.S. just triggered the largest short-term debt sale in history, a record $100 billion sale of 4-week T-bills.
$100 billion in 4-week Treasury bills.
Yes. It's not just a big number, it's unprecedented. It showcases both the sheer magnitude of U.S. borrowing needs right now and, I guess, its ability, for now, to attract investors.
But 4-week bills. That's basically short-term gap funding, right? Like a Band-Aid.
Exactly. A
Yeah.
Band-Aid solution, not a systemic fix. The government needs cash, and it needs it fast.
So this raises the question. Why is the largest nation, the one with the global reserve currency, resorting to such extreme short-term measures?
Does it signal desperation? Or just the reality of the times?
Could be seen that way, especially with the global economy already under immense strain. Look, just like any debt, when the U.S. borrows, eventually that debt comes due.
Right.
At that point, the U.S. typically has 2 options. Option 1, pay off the debt, which, let's be honest, it cannot afford to do, especially with ballooning deficits.
So that leaves option 2.
Roll over the debt, essentially issue new debt to cover the old debt that's maturing.
But the problem is...
We have a lot of debt maturing now. Our deficit continues to grow, and the interest payments on our existing debt are costing more and more.
Meaning we have to issue even more debt.
A lot more debt, leading to what some are calling a treasury bill deluge, just a massive, sustained flood of new short-term government debt that the market has to somehow absorb.
Potentially straining demand and liquidity.
Exactly. And while the headlines might say no trouble expected in the near term, the worries really loom beyond that immediate horizon. Historically, there's always been a buyer for U.S. debt, right, because of the dollar's reserve status perceived safety.
But you're saying that's changing.
Rapidly, countries are continuing to move away from the dollar. Why? Several reasons. The U.S. weaponization of the dollar through sanctions,
Right.
its exportation of inflation globally as the Fed prints more money, and just growing concerns around its credibility amidst this escalating debt.
So demand from traditional foreign buyers is shrinking.
It continues to shrink. And look, for anyone thinking the U.S. will never officially default, it's important to remember the U.S. has technically defaulted multiple times in history.
Really?
The 1790s, the federal government couldn't fully pay its debts. Even a partial default in 1933, when gold clauses and contracts were abrogated. But we don't even need an official "we're not paying you back" default.
What do you mean?
Think about inflation. If you borrowed $100 from someone 50 years ago and they paid you back that $100 today, nominal value is the same, but what's it actually worth?
Significantly less.
Exactly. This erosion of value, getting paid back nominally the same amount, but it being worth significantly less, that is why central banks in foreign nations are shifting into reliable stores of value, like gold.
They're protecting their wealth from this devaluation, this silent but persistent financial erosion.
Precisely.
Okay, so this context helps explain why President Trump, regardless of whether you agree with his policies or not, is calling for lower rates.
Part of it is making borrowing cheaper.
Right. A big component is the need to borrow a lot of money more cheaply. If rates come down, in theory, that helps bring borrowing costs down, allows the U.S. to refinance debt at lower rates. Because right now, as foreign demand declines, we can still borrow, but it's getting a lot more expensive, straining the federal budget.
So instead, we're shifting to these stopgap measures, like these massive short-term bill sales.
Seems like it. A 4-week T-bill? That's nothing in the grand scheme. Historically, it's for quick emergency cash needs, not a structural stopgap for $100 billion deficits.
And it means in just 4 weeks, that $100 billion needs refinancing again.
Creating a continuous cycle of short-term borrowing. It's not sustainable. It leaves the U.S. completely vulnerable to any kind of market volatility, shifts in investor sentiment, the whims of anyone out there who's borrowing.
Very exposed.
Very, very exposed. And if you think this is a one-off, think again. Just last week, U.S. Treasury Secretary Scott Bessent came out and said this is going to be the new norm.
The new norm, wow.
We can expect a lot more of this. To put it into context, that $100 billion 4-week bill offer, it's equivalent to more than a quarter of the total amount of bonds sold in the UK in their entire 2024-2025 fiscal year. And we're pushing that out as a 4-week short sale bond offering.
That scale is just staggering, unsustainable. And what's truly fascinating here, or maybe concerning, is understanding who is actually buying these T-bills.
Who is it?
Money market funds.
Okay. On the surface, that seems fine.
Maybe. But it brings up some serious liquidity concerns. This is where the real risk and potential for volatility could come from. Money market funds are designed for short-term, highly liquid investments.
What's the complication?
One major complication for money fund managers is that the Federal Reserve is expected to lower rates again, potentially as soon as September.
And when that happens?
Typically, you see an exodus from short-term debt. More people pile into longer-term debt to lock in higher yields before they fall further.
Meaning demand for these crucial short-term bills could just dry up because their yield becomes less attractive.
Precisely. Short-term debt, which used to be a tool for stopgap or emergency cash flow, suddenly has no interest. So when a tool you've relied on in your back pocket loses demand, what's your next layer of protection?
Doesn't sound good.
And it doesn't stop there. There are serious liquidity concerns here. These money market funds could potentially jeopardize U.S. banks and the system as a whole. The Treasury risks tipping the market to a point where it doesn't have enough liquidity to absorb all the debt.
Is there a way to gauge that liquidity?
One key gauge is the Fed's overnight reverse repo facility, the RRP. It acts like a pressure valve for excess cash in the financial system. When its usage declines sharply, like it has been.
It's your red flag.
Big red flag. It signals liquidity in the broader system is shrinking. When it gets too low, the system can freeze, seize up, potentially leading to bank failures.
And forcing the Fed
to fire up the printing press. Through quantitative easing, QE, or maybe even stealth QE, where they manipulate markets under the radar.
Which ultimately means
More inflation. Further devaluation of your dollar as more money chases the same amount of goods. Now, the Fed, as lender of last resort, will likely step in to prevent a full-blown collapse.
But the interim period could be messy.
Could see all kinds of issues popping up, sudden spikes in borrowing costs, market dislocations. So the bottom line here is, The U.S. is using emergency tools as regular tools
Severely limiting future options.
and leaving itself vulnerable to market volatility, to the whims of private funds that operate for profit, not to save the system. They'll go to the profit is, not where the system needs support.
This is a blaring alarm sign.
Absolutely. A blaring alarm sign that the U.S. dollar is completely losing its dominance on a global stage. We are adding debt, not taking it away. The question is, at what cost? And how long can this truly go on?
The future doesn't look bright for the dollar.
And the acceleration of these events is clear. Look, this isn't about scaring you, it's about educating you so you can have a strategy in place. There's a reason central banks and foreign nations are moving out of the dollar and into gold. The elites, the ones with insider knowledge, they're piling into gold because they see the writing on the wall for the dollar's long-term value.
Okay, so bringing this all together, what are the overarching implications for you, our dedicated listener? We've taken a deep dive into an incredible amount of information today.
The real whirlwind.
From surprising market rallies amidst global conflict, central bank struggles,
Ah,
to geopolitical flashpoints intensifying across continents,
yeah.
and these growing concerns over global debt and currency stability right here at home.
It's clear the world is in a period of intense transformation.
Yeah, economic realities forcing central banks to act despite their biases, geopolitical pressures reshaping trade and supply chains in unprecedented ways. Look, this isn't about fear, it's about understanding. The insights from these diverse sources, they paint a vivid picture of interconnected challenges, but also opportunities, allowing you to navigate this complex landscape with, hopefully, greater clarity.
Indeed. The Pringles can has definitely been popped when it comes to central bank rate cuts. It indicates a long period of easing is likely ahead, and the dollar's future. It's facing accelerating challenges as its global dominance wanes, a trend intensified by the current global environment.
Understanding these macro shifts is critical.
Not just for analysts' pie, but for you. They will undoubtedly impact your financial well-being, your daily life. So here's a final thought to leave you with.
Okay.
As we navigate this world where traditional economic indicators and central bank narratives seem to diverge so wildly from the ground truth, where these price illusions obscure real economic hardship, hidden debts pose systemic risks, and forced policy shifts reveal loss of control. How does understanding these underlying realities change your personal strategy for staying well-informed and resilient?
It's about looking beyond the headlines.
Truly grasping the forces at play.
Well, we hope this deep dive has given you plenty to think about. If you found value in today's deep dive, please take a moment to like and subscribe to our show.
Your support really helps us continue to bring you these in-depth analyses, giving you the knowledge you need to stay truly informed.
Thank you for joining us, and we look forward to our next deep dive together.